Today we're going to be talking about, is the market in balance or out of balance? Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. It's Thursday. We have the PEPPERSTONE webinar later today. Again, for those people who still looking for the link, I've just added it below. Myself and Chris Weston, who's the head of research for PEPPERSTONE, will be getting together at 4:30 Australian Western Standard Time. So again, the link below, you can check the time zone where you're at. I think it's going to be a fantastic event. Chris is a hugely knowledgeable individual, and it's basically taking a lot of the macro data that he's crunched and the bigger trend pictures, the US election, Brexit, a lot of the oil, gold indexes, currencies, and then also looking at the short time frame, the other extreme where I'm at. And today we're going to be talking about a concept known as imbalance or out of balance. We're going to be looking at how that played out yesterday. I haven't gone a lot of depth into this, but balance and out of balance are terms that Jim Dalton talks about in Market Profile. You can look at, learn more about that if you want to get his book, Mind Over Markets, Dalton and Dalton. But simple concept, one of the most important things to understand about each day when I go through my approach to the market. We talk about yesterday's high and low of the day, and one of the easiest things to understand, which people can relate to, that helps them sort of identify with where we're at, is, are we inside of yesterday's range? So if we're inside, then obviously today's range, today's high and low, are the most important as the day evolves, because that gives us an area of reference in terms of where price is contained. And what Dalton talks about is essentially in Market Profile is, as the day builds, you effectively get a bell curve of price action, and there's a middle area, and of course the market auctions from extreme to extreme, or often into the point of control before reversing or trending away and testing for value or other sellers or other buyers outside of these bell curves. But he talks about a concept of being out of balance, and when the market is out of balance, it has a huge possible potential for a wide-ranging day if it accepts that price area. Now, we talk about the three things that markets do. They break out, they pull back, and they trend. So that is essentially an example of a market that goes out of balance, searching for other buyers or sellers. If it doesn't find new business, it returns into the existing profile, which is a false break reversal, or it may tick outside of the range, as we see with the 1, 2, 3s. When we stop hunt to the high or to the low, pulls back inside and moves to the other side. Now we talk about some simple concepts, 50 pip boxes. It all ties together, but when the market goes out of balance in relation to the previous day, so if we break outside of a range in Asia and we are sitting outside up here somewhere, the next logical expectation is that London is either going to pull back inside of the previous day's range, so we might put a high of the day in place, or Asia may put a peak formation in place and we may reverse. But when the market's out of balance in Asia, we'll make this out here. So the market goes out of balance and we're out here. The next question is the market now going to stay out of balance and potentially have a big move? So we talk about narrow range days on the daily chart where we compress. We saw that on the British pound. Monday, Tuesday formed a large rectangle. They broke out of it and we had a measured move. Yesterday we saw the markets move lower, pound Aussie, pound New Zealand. They broke the previous day's lows. They broke outside of the Asian range, outside of the low. So Asia was opened up down below. The initial balance for Asia, that first half hour to hour of its high and low were established. And then it eventually broke outside of that and proceeded to go lower as we headed towards the 12 candle Europe-London session. We were also at double zeros and 50s on a few pairs, quarter levels. The first hour opened up in pound New Zealand and went sideways. When London opened, they went down 25 and then another 25 to the 50 level in that second candle. Now, we've talked about initial balance in relation to the week, the Monday, Tuesday. In Dalton's market profile, they talk about 50% of the time, the high and low will be in place in that first 30 minutes. Now, you've heard me focus on the equity hour. He also states that 75% of the time, the high and low of that session or the day can potentially be in place in that hour, in that first 60 minutes. So when London went down another 50 pips on the pound New Zealand and then pound yen, pound Aussie, they had all moved 25 to 50 pips. So again, we talked about stop hunts. Most stop hunts are 25 to 50 pips. We're out of balance. We're down low. The market opens and goes even lower. Okay, two numbers. Now, in that first 30 minutes, we had a low and a high in place. We then saw the market on pound New Zealand, pound Aussie pull back a little bit and work back into the low. So again, we talk about, are they working the high or are they working the low? We're looking for engulfments and pin hammers at the high of the day or the low of the day. Pound yen, pound USD. Pound USD on the second candle at numbers gave a little bull hammer at the low of the day. The third candle was another little bull hammer. The fourth candle was a bull hammer. We have a 1 hour pin bar at the very low of the day in a market that is now out of balance. We have a 1 bar stop and we have potential for asymmetrical risk reward, meaning that back to the high of the day, if the market was to come back, it had an opportunity not only to go to the high of the day, but then we've also talked about structure, measured moves. Now, Dalton talks also about these out of balance days and double distribution days. We're not going to go into the depth. I'm just explaining the concept that when we go outside of a previous session's range, okay, whether that be just the high and the low or the high and the low of that equity hour, which typically will set the high and the low. When we go outside of one of those ranges, when the next session opens, we have a high possibility of a market now to have either a reversal back into the range or a continuation for an even bigger move. So when we went down outside of the previous day's low, and then the market screamed away in the open of London, we don't know if that market isn't going to be trapping us down low to sell, pull back, for buyers who are off the bottom and then measured move again. But we know this, based on the price action for that initial balance, they gave us a buy low setup. So when we have a buy low setup, we now expect that the market should behave in a certain way. It went up, we're good after the first bar. It goes up again, we're good after the second bar. If it clears the 50% of that initial balance, we're now past what they call the point of control. So just in simple terms, if we have a high and a low in that first hour and we have a buy low signal, whether it be the second candle, the fourth candle, whatever that may be, we talked about the rotation in that hourly 15-minute cycle in the 12 candle window. If we have a buy low and it goes past the 50% level of that first initial balance, the next area that it will test is the opening candle of the London session. It went through the high of that candle. As we saw a 100 pip spike, 75 to 100 pip spike on all the pairs. I know some traders, I read some comments from other traders that were trading some other way. They couldn't understand how they got spiked out so fast if they thought it was their broker. That was a massive short squeeze at the low of the day after the consolidation of a 25 to 50 pip move outside of the Asian range. So a textbook perfect example of large possibility fast moves when the market is set up properly, and how that flies in the face of everything that retail traders are taught. Now, they're hard trades to take, but these are the types of trades that, again, you develop that skill in live time through starting simple. You start off, just again, timings for me is everything. The clock tells me everything, and then the behavior of price based on that time frame around the numbers at the high and low of the day, and that's how the rotation of my thinking is going through that process. Is where are we? Are we down low? I talked about this a couple days ago. They will make things look so good that it's going to break away and run without you. The moment you get in, depending on what time it is, you get in, it drops a bit, and the next candle comes back, and it still may roll over in your direction, but you could potentially be in underwater. So again, in every session when it starts in that 12 candle window, that pre-market hour sets up, they might move away. Traders talk about trading that. It doesn't matter, you can trade all of that. But when that equities hour starts and they put a high and low in place, they will potentially now either work, maybe it's going to be the high or the low are already in place when that first candle prints, if they've already extended the range out and locked it in at the high or low of the week. But after that first hour, they will most likely in each session have the high and low for that session already in place, and they will either extend out, work back into it for a W or an M formation, or a continuation for a trend trade reversal. So point being, every session I look at, are we opening up outside of the previous session? Are we outside of the previous day's high and low? How did price set up in that first initial balance? So again, if that pre-market hour takes us up high, chances are we might be going into a sell setup. And we talked, you could get brought up high for a sell setup that goes 3 pushes down and only goes 25 pips. Well, now we know that they might be bringing people up high to sell into a continuation move. Just little things like that. Timings, how many pushes, but that initial balance, are we inside of the previous session? Are we outside of the previous session? Are we inside of yesterday's range? Are we outside of yesterday's range?
Good day, traders. Stacey Burke, continuing our discussion on is the market in balance or out of balance? Again, a concept that Jim Dalton talks about in Market Profile. You can read more about it in his book, Mind Over Markets, or just Google Market Profile, Jim Dalton. But one of the concepts he speaks about is when a market goes out of balance, it potentially has an opportunity once it breaks out of a containment zone to possibly go on a big ranging day, a wide ranging day, or reverse and reject as it finds no new business outside of the previous profile area or trading range. So yesterday was a classic example. We broke out early from the previous day's low. I've shortened the window colors today purely to the equities hour, again, just to demonstrate. I've been really focusing on just making that hour my primary area, and I've been telling you that in my videos, that typically the high and the low will be established. That first hour is often the trap and the stop hunt. So we'll see a false move often in that first hour, and if we don't, we may see that in the equities hour. And we saw that yesterday where they dragged the market lower right off the bat. It was a continuation in that early Asian session before they go 1, 2, 3 into the previous day's low. So it started at the end of that 12 candle window, or the first hour of the 12 candle window, and then in the equities hour they went up 1, 2 into the high with a bullpen hammer. They engulf it and go sideways. Now this sideways price action is what's important, because this is what shows us where the market now, where that market's high and low levels are. And we see the market gradually fell through the low of the Asian range and the high-low profile. So again, our bell curve is from high to low. Our high and low of the Asian session, it gradually falls through, but also we're looking at round numbers. So we're at the 50 level. We dropped below that before the equities hour started. We go up 1, 2, 3 into the previous day's low, drop down and go sideways at the numbers at the top of a 50 pip box. It eventually drops through and rolls over. As we come into our Europe-London window, the first hour starts to go even lower. We get an engulfment right at the double zeros. And again, this is where talking about structure. So we have a high of the day in place. Again, I mentioned this concept and people ask me, what do you mean by working the low? Well, essentially, when we have a market that's gone sideways, we have a high and a low. We have a high of the day in Asia at this point, but the market continues to fall over. I'm almost immediately thinking buy low scenario, or some kind of three push pattern, unless the market aggressively comes back in that pre-market or even in the London hour, giving us a sell high setup for a measured move down. But the market, as we head into that first candle of the equities hour, pins at the double zeros and moves 25 pips lower. The first candle. They pull it back with an inside bar and then a little bull candle. So again, that 50% of the time, as mentioned in a session, the high and low will potentially be established in that first half an hour. In 75% of the time, the market will establish a high and a low within the first hour. So when we look at it in that sense, and I've talked about, again, the high and the low of the equities hour are usually in place by the end of that 12 candle window. One of those will typically hold. And then the concept of, are they working the low or working the high? Well, if they're working the low, we're thinking W. If they're working the high, we're thinking M. So I know traders have traded the move down. No problem. Great. Awesome. I'm looking at this from the perspective that if you've come along in here, it's difficult to just want to get in, because these are the scenarios that, for myself, this could encourage bad habits where you're chasing a move and next thing you know, London opens up and goes 1, 2, 3 up against the trend. So I'm very comfortable and relaxed to wait for that initial balance to print. And then again, we look at how it works the high or works the low in this particular instance, or extends the range out. In this particular instance, they pulled it back in the second and third candle, and then they hit the low again at the end of that equities hour before consolidating with almost a double inside bar, and then an engulfment as we head into that third candle of the third hour. That engulfment goes sideways, and we see the 50 pip stop hunt plus straight up in one candle, which was actually, I think, only a couple minutes on the very short time frame. Point I'm making here is that we come back to some simple concepts. The market was running away as we headed into the London Open. If we step back and look at timings and look at what's happened in that first half an hour, we have a high and a low in place. Now we want to watch to see, do they work the high or work the low? We've gone 25 and 50 pips outside plus of the Asian range. We broke through double zeros. We're working a quarter level below the double zeros. So again, a 25 pip stop hunt outside of a 100 pip box. We have double zero box. They rolled it off of halfway point. They come 25 pips outside of the range. I say this a lot. Double zeros and 50s, 25 pip boxes will typically be the stop hunt zone outside of a 50 pip box. Then, of course, we see the market pull back, consolidate before continuing its move. So the other thing to consider now is structure, because the market isn't even into the next 12 candle window prior to us, and we're already outside of the high of the day with a big bullpen hammer in the 7 o'clock stop hunt hour as we head into the 12 candle window. So the measured move concept is now we have geometry, and we look at the mirror image of that as a possible minimum target. So rather than 50 pips, or if you've taken your 50, now we see that this market, again, the pin acting possibly as a flip zone, could give us another move back in line with the trend. Pound New Zealand, very similar. We went out of balance early in the day. So again, the market accepted being outside of the range. It accepted being out of balance from the previous day's low, even though this is more of a continuation. It's still relevant. We didn't trap traders with a peak formation low in reverse. It continued to fall through the low of Asia. And again, to the numbers, drops down, and London opens up just above the quarter level to extend the stop hunt 50 pips outside of the Asian range before, again, our first two bars of that London hour establishing potentially a high and a low for the session. They come back and work the low a second time before giving us the double inside bar and the engulfment, the sideways movement, and the pin back up top. So this is a hard concept for retail traders to digest, but when you look at it from the market profile perspective, purely from the sense of a high and low and then working from a low or off the high, it makes complete sense. So something to grasp, and again, we're in a 50 pip box. The market sets the high and low. They work down into it. It pulls away. This is a third push, and then it shifts away. To me, the ideal setup was the pound. I mean, irrelevant in terms of just my own perspective of this, how clean this chart was with a little bull hammer at the low of the day. They went sideways into the Asian range. They come down, pin the previous day's low in the equities hour, and go sideways. And again, you'll notice that sideways price action is at the top of the first candle of the equities hour. So again, our profile was in place. The market worked up into the high of the profile 3 times before dropping down and going sideways. So now we're out of balance again with the Asian range. The market has gone out of balance not only from Asia, but from the previous day's range, and extends it out. Our pre-market breaks down through the double zeros, and then the equities hour opens up, pins into the double zeros, drops down. We pin just below there. The market is at a quarter level. We get the bull candle, the second bull candle, and the third bull candle, little bull candle pin at the end of the equities hour. This is effectively a pin bar on the 1 hour. This little bull reversal pin is the telltale gold sign, because as soon as they break that doji, it's a runaway market. And again, the measured move, high of the day, they pin up through it. So again, we look at the mirror image as a minimum possible target, and the market, of course, hits that. But even just in terms of being a 50 pip box, we're looking at 100 pips of potential targeting. So timings are everything. Each 12 candle window and the equities hour will typically establish the high or low for that session. And again, there are different variations of this depending on where we're at. So Dalton talks about the type of day or the type of session. We can get an open auction. We can get an open drive, different types of scenarios. In the U.S. session, we had a high. We have an auction back and forth, which is exactly what happened. They expand the range up, they come back down and expand the range on the bottom and go into consolidation. So just a simple concept to keep in mind: are we inside of the previous session's range? Are we inside of the previous day's range? If we break out, then how price behaves can establish if we are in a market that potentially may continue to range and go on a trend, or reject and pull back and possibly trade to the other side for the false break reversal trade. So hopefully you got some value from today's video, traders. Keep it simple. Time of day, again, just at first half an hour and first hour, how price behaves off the highs and lows of that. Are we working down low at the low of the week? Are we working up high at the high of the week? Are we inside of the previous session's high and low? Keep it simple. Have a great trading session. Enjoy the webinar, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.